Have you ever looked at a company's financial report and just thought, wow, what actually goes into making sure these numbers are, solid?
Right.
Or maybe pictured yourself like a financial detective digging through data?
Uh,
Well, today that's pretty much what we're doing. We're diving deep into how auditors check financial statements, looking specifically at misstatements, what they are, what they mean.
yeah, it's our mission for this deep dive, really pull back the curtain.
Exactly.
And it's not just like catching math mistakes, not at all. It's fundamental. It's about trust, reliability,
Yeah.
the information that drives huge decisions.
Decisions by investors, lenders.
Even the company itself, planning its strategy. It's all built on trusting those numbers.
So we're going to break down some pretty complex audit ideas, but focus on why these details matter so much, not just the what.
Okay, let's get into it. Because honestly, even if you're not an auditor, understanding this helps you appreciate the work involved
Definitely.
and maybe helps you spot potential red flags yourself,
Yeah.
right? In any data you see.
Yeah.
That makes you a bit sharper, a more critical eye. Exactly.
So, okay, picture this. The auditor's done weeks, maybe months of digging, checking ledgers, talking to people, verifying things.
Yeah, it's exhaustive work.
What's the grand finale? When they're forming that final opinion on the company's finances, what are they actually looking at? It's got to be more than just adding up numbers, surely.
Oh, absolutely. Way more. That final evaluation, it's comprehensive, not a checklist. It's about bringing all the pieces together, synthesizing everything they found.
Like putting together a big jigsaw puzzle.
Exactly. Stepping back, seeing the whole picture, connecting the dots from all the tests, all the evidence.
Yeah.
And one key piece they revisit right at the end is analytical procedures. These are done during the overall review.
Okay, what does that involve practically?
Think high-level checks, comparisons, looking for weird relationships, unexpected jumps or drops in the numbers compared to last year, or industry averages, maybe even things like production volume.
Like a financial heartbeat check.
That's a great way to put it. Are there sudden spikes in receivables that don't match sales? Or a big dip in margins that nobody can explain? These analytics either confirm things look reasonable or they flag areas needing one last look for potential. Misstatements.
Okay. So it leads us right back to misstatements. That's the core, isn't it?
It really is.
Yeah.
Which brings us to the second element, evaluating all the statements they found during the audit. And this includes any that haven't been corrected yet.
So every little error or discrepancy they noted down.
Every single one, unless it's truly tiny, which we'll get to. They track these meticulously, and at the end, they look them all together individually and add it up to see the total impact. Accidental errors, mistakes in applying rules, even potential fraud indicators.
Got it. What else is in that final review?
Third, they look really hard at the qualitative aspects of the company's accounting practices.
Qualitative. So not just the numbers, but how they do the numbers.
Precisely. How are they applying the accounting rules? What judgments are they making? Are they consistently conservative, sort of cautious?
Or maybe a bit aggressive.
Exactly. Leaning towards recognizing revenue maybe a bit early, pushing expenses into the next period. It hints at the judgment involved, the philosophy, like you said. Does it paint a fair picture, or is it skewed to look better?
That's fascinating. It's about the intent behind the numbers almost, which I guess leads to fraud.
It certainly can.
Yeah.
That's the fourth point.
Oh.
Looking for any conditions that suggest fraud risk. Auditors are actively scanning for red flags.
Like what sort of things?
Could be weak internal controls, systems that are easy to manipulate, or really complex, unusual deals with no obvious business reason. Maybe intense pressure on management to hit targets.
Ah, the pressure cooker.
Yeah, that can create incentives. So auditors need heightened skepticism if they see these signs. They're not just looking for honest mistakes anymore.
Okay, what else?
Fifth is the presentation and disclosures. Super important.
Meaning how the information is actually laid out, the notes and stuff.
Exactly. The numbers might be technically right, but do they tell the full, clear story? Are the explanations, the footnotes, comprehensive, understandable, or are they confusing, maybe even misleading? Transparency is key for users.
Right, you need the context.
Absolutely. And finally, the auditor does a kind of self-check. They evaluate the sufficiency and appropriateness of the audit evidence they gathered.
So basically, did we do enough? Is our proof solid?
You got it. Have we collected enough reliable, relevant information to back up our opinion? Is it persuasive? If they feel there's a gap, maybe not enough evidence for a specific account, they might have to do more work even at this late stage.
Wow. It's incredibly thorough. We keep saying misstatements. Let's nail that down. What exactly is one, technically? And maybe more importantly, how do auditors decide which ones actually matter? Because it feels like that could get really tricky, right? A small error here, a rounding thing there.
It is tricky, and it's where a huge amount of professional judgment comes in. Fundamentally, a misstatement is just a difference between what's reported in the financial statements, the amount, how it's classified, presented, or disclosed, and what should be reported according to the rules, the financial reporting framework.
So basically, it's wrong compared to the rule book. Could be an accident, could be not an accident.
Exactly. Error or fraud. That's the basic definition.
Okay, but here's where our source material gets really interesting. It draws this line, a really important distinction between something being not material and something being clearly trivial. They sound similar, but what's the actual difference? Why does it matter?
Yes, that's a fantastic point and crucial for how audits work efficiently. Clearly trivial means, well, exactly that. It's completely inconsequential. Peanuts.
So truly tiny.
Truly tiny, yes. But it's not just about the size.
Hmm?
It has to be inconsequential individually, and when you add it up with all other trivial things, and by any reasonable measure size, what it relates to, the situation, and the key word is clearly. If there's any doubt, any uncertainty at all.
Then it's not trivial.
Correct. If there's any question, it gets accumulated with all the other non-trivial misstatements and evaluated properly for materiality later. Auditors can set a specific dollar amount, a threshold, below which things are deemed clearly trivial and aren't formally tracked.
Okay.
But that threshold is set very carefully. They have to be sure that even a whole bunch of these tiny items wouldn't add up to anything material, even considering there might be other errors they haven't even found yet.
So it's an efficiency thing, but with big safety rails.
Precisely. It lets them focus on what actually matters.
All right, so if it's not clearly trivial, it gets onto the list. And then the big question is it material? How do they figure that out? Is it just about the dollar amount then? You mentioned a $10,000 error earlier. Huge for a startup, maybe nothing for a giant corporation.
Exactly. And that hits the nail on the head. It is absolutely not just the dollar amount. Materiality is this blend, this art and science, combining quantitative factors, the numbers, with qualitative factors, the context, the nature of the error.
Okay, let's break that down. Quantitative first.
Right. Quantitatively, they look at the size of the error compared to a relevant base. Like you said, maybe net income, maybe total assets, maybe revenue. Depends what users of the financials care most about for that specific company.
So the $10 K are versus startup profits versus Fortune 500 profits.
Perfect example. Context is everything for the number. They also have to look at the errors individually and in aggregate. Lots of small leaks can sink a ship, right? 5 errors of $20,000 each might seem small alone, but together that's $100,000, which could be very material.
Makes sense, adding them all up.
And then there's the risk of undetected misstatements. This is a bit more subtle. As the errors they have found start piling up and getting close to their materiality level,
They get nervous.
they get more cautious, yes. You have to think, okay, we found this much wrong. What if there's more we haven't found? That risk might push the total over the line, so they might need to do more testing if things are looking close.
Right, the known unknowns, or unknown unknowns.
Kind of. And they also consider prior period misstatements. Errors from last year might still be affecting this year's numbers. They have to track that cumulative effect too.
Okay, that covers the numbers part. But you said qualitative factors can make a small number a big problem. This is where it gets really interesting, isn't it? What kind of things make a numerically small error suddenly material?
This is absolutely where the judgment really kicks in. It's about the story the numbers tell and how an error, even a small one, twists that story.
Okay, give me some examples.
Well, a classic one is if it affects trends or masks a change. Say a company boasts about steady profit growth. A small error that hides a dip, or worse, turns a small loss into a tiny profit.
Oh, that's huge for investors. Completely changes the narrative.
Exactly. That small error becomes highly material because it's misleading about performance trends. Or what if the error affects compliance? Like it causes the company to accidentally violate a loan covenant, maybe a debt ratio limit set by the bank?
So a tiny error could trigger a loan default?
Potentially, yes.
Yeah.
Or penalties. Suddenly, that small number has massive real-world consequences. Materiality isn't just about the financial statements themselves, but their implications.
Wow. Okay, what else?
How about if it increases management pay, or if it suggests management bias, or if it relates to fraud or illegal acts? Even a tiny amount involved in fraud is almost always considered material because it signals a major integrity problem.
Right. If management's cooking the books, even slightly, that's a huge red
A
flag.
massive red flag. Also think about segment information. An error might be small for the whole company, but if it drastically distorts the results of one key business division, that's misleading. Or if it's currently immaterial, but likely to become material later. Maybe an error in accounting for a long-term contract that will snowball in future years. Needs fixing now.
Proactive correction.
Yes. And sometimes it's just that the error indicates a risk of more errors lurking undetected. Like that small leak in the dam analogy, it might be a symptom of a bigger systemic problem.
So it's not just the error itself, but what it might represent.
Precisely. It's a very holistic view.
Now, you mentioned management bias. Auditors are looking for honest mistakes, sure, but also intentional distortion. What does that bias actually look like? And how do auditors deal with it? It seems like a delicate thing to challenge the bosses.
It is delicate, but absolutely necessary. Auditors have to consider potential bias in management's judgments. It's often subtle, woven into choices and estimates.
So how does it show up?
Well, one way is selective correction. Management happily fixes errors. The auditor finds that make profits look better, but they argue against fixing errors that make profits look worse.
Ah, the convenient corrections.
Exactly. Or maybe the auditor finds an error that lowers income. Suddenly, management finds another adjustment, maybe a subjective one, that perfectly offsets it, boosting income back up. Looks neutral, but hides the original problem.
Sneaky.
Can be. Bias can also be in how they choose accounting rules or make estimates. Always picking the most optimistic assumption, maybe underestimating bad debts, overestimating asset lives to cut depreciation. If there's a pattern of choices that consistently paints a rosier picture, that's bias.
So what happens if the auditor spots this pattern?
It's a serious concern. They have to evaluate if that bias, combined with any other uncorrected mistakes, adds up to make the financial statements materially misstated overall. It really underscores the auditor's role as that skeptical watchdog, protecting the integrity of the report from manipulation.
Okay. The auditor's done the hard work, found misstatements, figured out which ones matter, maybe even sniffed out some bias. What's the next step? It can't be as simple as firing off an email saying, hey, you messed up. How does that conversation actually happen?
No, definitely not just an email. It's a formal, structured process. Auditors have to communicate all the misstatements they accumulated, everything except the clearly trivial stuff to the right level of management, usually senior management or the finance director. And it needs to be timely.
All of them, not just the big ones.
All accumulated ones. It often involves preparing detailed schedules outlining each item, the amount, and the impact. Then there's usually a meeting to discuss them.
Okay, and then what? They just present the list.
They present the list, and then they formally request management to correct these misstatements. And this is key. The auditor requests, they propose the corrections. Management ultimately owns the financial statements.
So management has the final say on whether to actually book the changes.
Exactly. Management decides. Now, hopefully they agree. If management does correct a certain type of error, say in accounts payable, the auditor then often does more testing in that area just to be sure the fix was complete and no other similar errors remain, double-checking the fix.
Makes sense. Due diligence.
Right. Or if the auditor's finding was based on a sample, like they estimated errors in inventory based on testing a small portion, they might ask management to go examine the entire inventory themselves to find the actual total error and adjust for that precise amount.
Putting the onus back on them to find the exact number.
Yes. And they'll push for all factual misstatements, things that are just plain wrong according to the rules to be corrected, unless trivial. For judgmental ones, like disagreements over an estimate's fairness, they'll ask management to revisit their assumptions and methods, try to find common ground.
But what if management just says no? What if they dig their heels in? Nope, we think our estimate is fine, or that error isn't important enough to fix? That must happen, right?
Oh, it definitely happens. And it puts the auditor at a critical spot. If management refuses, the first thing the auditor must do is get a clear understanding of why, what are their reasons, because that reason feeds directly into the auditor's overall evaluation. Does the refusal seem reasonable, or does it reinforce concerns about bias or the overall reliability of the financials? Even if management refuses, the auditors still have to conclude whether the remaining uncorrected misstatements, all added together, make the financial statements materially misstated or not.
So the refusal itself is part of the evidence, in a way.
In a way, yes. It informs their judgment. And importantly, even if the uncorrected errors are deemed not material this year, the auditor still has to communicate them to the audit committee or board, warning them that these items could cause future financials to be materially misstated if left unfixed.
A forward-looking warning. Fix it now or face bigger problems later.
Pretty much. It puts the responsibility squarely on those charged with governance.
Now, our source material has this great example, a summary of possible misstatements table for ABC Company. Walking through this might really help illustrate how these things add up.
Yeah, that's a perfect example of the kind of schedule auditors provide. Let's look at it. You see columns for the type of misstatement, the amount, and then the effect on assets, liabilities, and income before tax. Very clear.
Okay, first line. Unrecorded liabilities for $80,000. How does that break down?
Right. So if liabilities are unrecorded, the company owes more than it's showing. Liabilities normally have a credit balance, so to record this $80 K, you'd credit liabilities, increasing them. That's the effect on liabilities. Plus $80. Usually this also means an expense wasn't recorded.
Like an unpaid bill.
Exactly. So expenses are understated, which means income is overstated. To fix that, you'd record the expense with a debit, which decreases income. So effect on income. Nagish $80. No direct asset impact here.
Got it. Next, overstated allowance for uncollectible accounts for $45,000. Allowance that reduces receivables, right?
Correct. It's a contra asset, credit balance. If it's overstated, they set aside too much for bad debts, making assets look lower than they are. To fix it, you need to decrease the allowance. You decrease a credit balance with a debit.
So debit allowance, which increases assets.
Increases net assets by $45K, yes. And the other side of that entry is usually credit to bad debt expense. Crediting an expense decreases it, which increases income. So effect on assets plus $45K, effect on income plus $45K.
Okay, following that. Last one. Difference between inventory count and ledger for $60,000. Let's say the count was lower than the books.
Okay, so inventory is understated on the count sheet by $60K. Inventory is an asset, debit balance. To increase it to the correct amount, you debit inventory $60K, effect on assets, plus $60. Now, in a periodic system, if ending inventory is understated,
Then cost of goods sold is overstated.
because that
formula.
Exactly. COGS and expense debit balance is too high. To decrease it, you credit cost of goods sold $60. Decreasing an expense increases income. Effect on income plus $60K.
Wow. Okay, so let's look at the bottom line, the net effect.
Right. Add up the columns. Assets, $0 plus $45K plus $60K plus $60K will net increase of $105K. Liabilities, just the $80K increase. Income before tax, net is $80K plus $45K plus $60K, a net increase of $25K. See how even individually smaller items can combine. That $25K net effect on income might be material, even if the $45K or $60K alone wasn't.
That really clarifies the aggregate impact. So here's that passkey moment from the sources who actually posts these entries.
Management. Always management. The auditor provides the schedule like the one we just discussed, explains why it's needed, but management decides whether to actually adjust their books.
And if they don't, and the auditor thinks the remaining errors aren't material in total,
then the auditor must document everything. They list the uncorrected errors in their work papers and clearly state their conclusion that despite these errors, the financials are not materially misstated overall, and explain why they reached that conclusion. Documentation is paramount.
Speaking of documentation, what exactly are they required to write down? Sounds like a lot.
It is, but it's crucial. They have to document, 1, that clearly trivial amount. We talked about the threshold they used.
Okay.
2, all the misstatements they accumulated during the audit, clearly showing which ones were corrected and which weren't.
An asterisk list.
3, their conclusion on whether the uncorrected misstatements are material, individually, or combined. And critically, the basis for that conclusion, the reasoning, the factors considered.
Oh, why?
Exactly. And specifically for the uncorrected ones, they need to document their total aggregate effect, whether they breach any materiality levels set for specific accounts, and their impact on key ratios, trends, or compliance, things like loan covenants. It's about creating a robust audit trail, showing exactly what was found, what wasn't fixed, and why the auditor still believes the overall picture is fair.
We've been deep in the numbers, finding errors. But what if finding an error points to something bigger? A weakness in the company's own systems that let the error slip through? Like finding a crack in the foundation. How does that connect?
That's a fantastic question, and it's a critical link. Because finding errors isn't just about fixing the numbers, it's about understanding why they happened. And if an auditor finds a material misstatement that the company's own internal controls should have caught but didn't, that is a direct, strong indicator of something auditors call a material weakness in internal control.
Material weakness. Okay, what does that mean exactly?
It means there's a deficiency or maybe several deficiencies combined in the company's internal system for financial reporting. A deficiency serious enough that there's a reasonable possibility a material misstatement won't be prevented or caught and fixed in time by their own people and processes.
So if a big error got through the net itself has a serious hole.
That's a perfect analogy. The system failed its primary job in that instance.
Now, you mentioned a nuance earlier. A material misstatement means there is a material weakness, but having a material weakness doesn't automatically mean the financials are currently misstated. How does that work?
It's subtle but important. Finding the actual misstatement is proof the weakness exists, and it caused a problem this time. But you could have the weakness, the hole in the net, without a material error having slipped through yet.
Like a potential problem waiting to happen.
Exactly. Maybe controls over inventory valuation are weak, but this year, by luck or maybe some extra manual checks someone did, the final number happened to be okay. The risk from the weakness is still there, even if the bad outcome didn't materialize in this specific period. But the auditor still needs to report that weakness.
Right. It's about the risk going forward, too. So auditors aren't just counting errors, they're analyzing the why. What specifically are they looking at when they evaluate the cause?
They dig into it. First, frequency. Was this a one-off fluke, or is it happening repeatedly? A recurring error is much more worrying, suggests a systemic problem, not just a random mistake.
Okay, frequency. What else?
Second, the effect on other audit areas. Does this error in, say, revenue also imply potential problems in accounts receivable, or maybe even returns processing? Errors rarely live in isolation. They look for those ripple effects.
Connecting the dots again?
Always. And third, the broader financial statement implications. Beyond the numbers, what does it distort? Key ratios, compliance, the overall picture.
And if this analysis shows the controls are weaker than they first thought,
Then they have to reassess audit risk. Their whole plan might need to change. Maybe they thought they could rely on certain controls, but now they can't.
so more testing, bigger samples.
Could be, or different types of tests. More direct testing of balances, less reliance on the system. It can significantly change the audit scope and focus even late in the game. And importantly, they evaluate all misstatements this way, even small dollar ones.
Because even a small one could signal that bigger crack in the foundation.
Precisely. That small leak could be the warning sign of a much bigger structural issue in the controls. You can't ignore the symptoms just because the initial damage seems minor.
All right, we've covered finding errors, evaluating them, understanding their cause. Now, how do you actually fix them in the accounting system? This is where we get down to the mechanics, right? The adjusting journal entries.
Exactly. Adjusting journal entries, or AJEs, are the tool. They're the formal way accountants correct misstatements or record things that haven't been booked yet, like accruals. They can hit any account, assets, liabilities, equity, revenue, expense, whatever needs fixing to make the final statements accurate.
Now, to really get how these work, it probably helps to quickly recap how accounts normally behave, like what makes them go up or down.
Yeah.
Debits and credits. Can we do a super quick refresher?
Good idea. Knowing the natural balance is key to making corrections very quickly. Assets and expenses naturally have debit balances. Debits increase them, credits decrease them.
Got it. Assets, expenses, equals debit.
Liabilities, equity, and revenue sales naturally have credit balances. Credits increase them, debits decrease them.
Okay. Liabilities, equity, revenue, credit.
Keep those rules in mind, and you can adjust almost anything. Let's take an example we touched on. Sales and accounts receivable are overstated, too high.
Right.
Sales has a natural credit balance. To decrease it, we need to debit sales. Accounts receivable is an asset, natural debit balance. To decrease it, we need to adjust building. Credit accounts receivable.
So the entry is debit sales, credit accounts receivable.
Perfect. The journal entry would be sales, XXX debit, accounts receivable, XX credit, to adjust sales and accounts receivable to correct amounts. That one entry fixes both the income statement and the balance sheet. It's how you bring things back into line.
Okay, let's hit some specific tricky areas. Purchases. There's this shipping detail. FOB shipping point versus FOB destination. Sounds technical, but why is it such a big deal for getting inventory right, especially at year end?
FOB, free on board. It sounds small, but it's huge because it defines exactly when legal ownership transfers. And that dictates whose balance sheet the inventory should be on at year end. It's a major headache for cutoff testing.
Okay, break it down. If my company is the buyer.
If you're the buyer, FOB shipping point. You own it as soon as it leaves the seller's dock. So if it's on a truck on December 31st, it's your inventory. You need to record it, even if you haven't received it. FOB destination. You only own it when it arrives at your door. If it's on the truck on December 31st, it still belongs to the seller. Don't include it yet.
Okay, clear. And if my company is the seller?
If you're the seller, FOB shipping point. The buyer owns it once it ships, so get it off your books as soon as it leaves. It's not your inventory anymore at year end. FOB destination. You still own it while it's in transit. Keep it on your books until it reaches the buyer's destination.
So it really matters who owns the goods on the truck at midnight on New Year's Eve.
Precisely. It's a common source of errors if companies don't pay close attention to those terms on their purchase orders and sales invoices.
Got it. Now, inventory systems, perpetual versus periodic. How do these different ways of tracking inventory affect how auditors approach adjustments?
They create different risks and require different focuses. Perpetual system updates inventory records constantly with every sale and purchase. In theory, you always know your inventory level and KGS. Auditors often focus on testing the system's controls. Is it accurate? Then they compare the system records to a physical count, and big differences usually signal control problems or errors needing adjustment.
So trust but verify the system.
Pretty much. Periodic system. Only updates inventory at the end of the period, after a physical count. Sales are recorded, but KGS is calculated later using that formula. Beginning inventory plus purchases ending inventory equals KGS. Here, the auditor's main focus is on the accuracy of that physical count. If the ending count is wrong, KGS is wrong, and so is profit.
The count is everything in periodic.
It's hugely important.
Let's use that ABC company example again. Periodic system. They missed $20,000 of inventory in the count. Walk us through fixing that again, step by step.
Okay. Periodic system, $20K inventory missed.
Right.
1. Problem. Ending inventory is understated by $20. 2. Fix inventory. Inventory asset debit balance needs to go up. So debit inventory $20,000. Balance sheet fixed.
Step 1, fix the asset.
3. Impact on KGS. Remember the formula. BI plus PEI equals KGS. If ending inventory, EI, was understated by $20, then KGS was overstated by $20K.
Right, subtracting too small a number made KGS too big.
4. Fix KGS. KGS expense debit balance needs to go down. To decrease it, you credit cost of goods sold $20,000. Income statement fixed.
So the full entry is debit inventory, credit KGS.
Exactly. Inventory $20,000. Debit cost of goods sold $20,000. Correct inventory and KGS for omitted items. That single entry sorts out both the balance sheet asset and the income statement expense, correcting net income too. Shows how interconnected it all is.
Definitely. One last tricky area, consignment. Goods you hold but don't own, or goods you own but someone else holds. How does that work for inventory?
Ah, yes, consignment. It's all about legal ownership versus physical location.
Oh.
If your client is a consignee, they're holding someone else's goods to sell, like that boutique with the designer's clothes. Those goods must be excluded from their inventory. They don't own them. Auditors check these aren't accidentally included.
Keep other people's stuff separate.
If your client is the consignor, their goods are held by someone else for sale, like the jewelry designer, those goods must be included in their inventory. They still own them until sold. Auditors check these haven't been forgotten.
So it's about who truly owns it, not just where it physically sits.
That's the bottom line for consignment. Ownership, not possession. #tag outro.
Wow. Okay, so wrapping this up, what have we learned? We've really peeled back the layers on the incredible detail auditors go into.
We sure have.
From that big picture evaluation at the end to drilling down into what materiality really means way beyond just the dollars.
Right, the qualitative side is huge.
Then navigating that sometimes tricky communication with management about corrections, dealing with pushback.
The auditor management dance, yeah.
And seeing how finding one error can actually point to deeper problems with internal controls. And finally, the actual mechanics of fixing things with adjusting entries.
Tying it back to those basic debit credit rules.
So connecting this to the big picture, why should someone listening care about all this detail?
Well, understanding how misstatements get found, evaluated, corrected, it's just vital if you rely on financial information at all. Whether you're an investor, a business owner, even just someone interested in how the economy works.
Yeah.
It shows that good financial reporting isn't just about getting the math right. It's about judgment, about integrity, about building that foundation of trust we need for, well, pretty much everything in business.
That's a great point. So maybe a final thought for our listeners. Next time you see a company's financial report or hear about some big business decision based on the numbers, think about all this unseen work, the layers of checking, the judgments, the arguments maybe, what subtle assumptions might still be in there. This deep dive hopefully gives you, a bit of a shortcut to asking smarter questions.
A deeper appreciation for what goes into making those numbers something you can actually rely on.
Exactly. Having a bit more financial assurance awareness.